You know, in the world of finance, there's this one number that kind of haunts every investor, every executive, every entrepreneur. It's a number that can build fortunes or, well, shatter them. And it all boils down to answering one absolutely critical question.
Seems pretty simple, right? But honestly, that question, it's the bedrock of all of finance. If you get it right, you could be the next Warren Buffett. Get it wrong, and, well, the stakes are just incredibly high. Because this isn't just about a number, it's a judgment call on a company's past, its present, and its entire future.
But here's the thing, there's no single magic formula to spit out the answer. Instead, analysts use a whole toolkit of different approaches, and each one is like a unique lens for looking at a company's value. And today, we're going to open up that toolkit and see what's inside.
So, let's frame our exploration as a quest, a search for that elusive, true value. And just like any good quest, we've got a map, and it's got a few different paths we can take to get to the treasure. Think of it like this. First, you can be the architect. You can draw up a super detailed blueprint based on the company's own potential to make money. Or you could be the pollster, taking the market's pulse to see what everyone else thinks it's worth. Or you could be the strategist, placing a calculated bet on a future that hasn't even happened yet. Now, the two most common paths are intrinsic and relative valuation. So with intrinsic valuation, you're looking inward. You're asking, based on all the cash this business can crank out over its lifetime, what should it be worth? It's a fundamental bottom-up approach. Then there's relative valuation, which is all about looking outward. It asks, hey, what's the market paying for similar companies right now? It's all about comparison.
All right, let's dive in with that first one, the architect's approach, intrinsic value. And the number one tool for this is a method called discounted cash flow, or DCF. I mean, this is really the bedrock of modern valuation.
So the core idea here is actually pretty simple, but it's incredibly powerful. A company is worth the sum of all the cash it's ever going to produce in the future. But there's a catch. $1 tomorrow is worth less than $1 today, right? So we have to discount all that future cash to figure out what it's worth right now, in the present. It's really all about a company's future earning power.
Now, the idea sounds elegant, but actually doing it? That's where it gets tricky. One of the most common and most critical mistakes is a simple mismatch. Seriously, think of it like trying to use a screwdriver to hammer a nail. You absolutely have to match the right kind of cash flow with the right kind of discount rate.
Okay, so what does it look like when you do it right? Well, in this example, it doesn't matter if you start by valuing just the equity or the entire firm. If you're consistent, if you use the right inputs, you land on the exact same answer. The company's equity is worth $1,073. It's clean, it's logical, it works.
But here's where the danger lies. What happens if we make that super common mistake? What if we accidentally discount the cash flows that belong to equity holders, but we use a rate that's meant for the whole firm?
And boom! This just shows you the huge impact. Look at that. A simple mismatch, and all of a sudden the value jumps from about $1,000 to almost $1,250. That's an overvaluation of more than 16%. It's the exact same company, the same cash flows, but one tiny logical error creates a massively different and completely wrong conclusion. This is why the details matter so much in valuation.
Okay, so that's the architect's meticulous blueprint. Now let's switch gears and check the market's pulse with our second approach, relative valuation. This is usually done with something called multiples. Now this method is way more straightforward. Instead of forecasting decades of cash flows, you just look at how similar companies are priced in the market today. It's literally like valuing a house by checking what similar homes on the same block just sold for. You find a group of comparable companies, see what multiple of their earnings people are paying, and then you apply that multiple to your company. And you can see why this is so popular, right? It's fast, it's easy to understand, and it feels grounded in what's happening in the market right now. But, and this is a big but, that simplicity is also its greatest weakness. The entire valuation hangs on one very subjective judgment. What exactly counts as a comparable company?
So let's say you're an analyst valuing a software company. You pull up a list of other software firms, and you see that, on average, they traded about 24 times their earnings. Okay, simple enough. The baseline valuation is set.
But here's where it gets a little sketchy. An average is only as good as the numbers you put into it. So what if the analyst has a bias? What if they already want the company to look expensive or cheap?
And just look at what happens if that analyst just conveniently decides to remove the two companies with the lowest PE ratios. The average suddenly jumps 11% to 26.7. Or if they want a lower number, they just remove the two most expensive firms and boom, the average drops by 12%. It's the same market, but with a few clicks of a mouse, the final valuation can swing by over 20%. It's not necessarily lying, but it is highly, highly subjective.
Okay, so we've got the internal blueprint, and we've got the market's pulse. But what about the really tricky stuff? Assets that don't have cash flows today and have no easy comparisons. How do you value pure potential? This brings us to our third approach, the strategist's bet.
This is called contingent claim valuation, or option valuation. The magic word here is contingent. The asset's value is contingent or depends on some future event happening. It's a way of valuing the right, but not the obligation, to do something in the future. Basically, it's a tool for valuing the big what-ifs.
I mean, think about it. A patent for a new drug that's still in trials. A plot of land with oil under it that's not being drilled yet. A startup with some amazing new tech that isn't making money. A standard DCF would say these are worth zero because there's no cash today and you can't really compare them to anything. But we all know these things have value, right?
This is where financial option models come in, and they're perfect for this. You're not valuing a certainty. You're valuing the opportunity. Think of it like this. If that drug trial is a success, the patent becomes a goldmine. If oil prices shoot up, those reserves are suddenly worth drilling. As you can see here, the downside is capped. The worst that can happen is it's worth zero. But the upside is potentially unlimited. You're not valuing the asset itself. You're valuing the option on that asset.
So there you have it, our three main approaches: intrinsic, relative, and contingent claim. Each one tells a different piece of the story. A DCF tells you what a company should be worth based on its fundamentals. A multiples analysis tells you what the market thinks it's worth today. And an option model values its hidden potential. The real art of valuation isn't just mastering one of these. It's knowing which tool to pull out of the bag for the right job.
At the end of the day, a really great analyst doesn't just have a favorite hammer. They've got the whole toolkit. They know the strengths and weaknesses of every single tool, and by using them together, they can start to triangulate and get a much more robust and defensible idea of a company's true value. They're not just finding a number, they're stress testing a story.
So from now on, when you see a stock price, try not to see just a number. Try to see the argument behind it. Is that price an architect's blueprint built on the promise of future cash? Is it a pollster's snapshot of the market's mood right now? Or is it a strategist's bet on a brilliant what-if? Because once you understand how value is created and how it's debated, you're no longer just looking at the price, you're reading the story.